we're going through a pretty significant macro transition. We were in an era for 15 years of, the greatest monetary stimulation in modern finance, like over the last hundreds of years, right? And so what happened during that period? Well, everything went up, and the more risky the thing that you bought, the smarter you looked, right? And that is over. The era of cheap money, zero interest rates, that is over, and it's not coming back. And so then the question becomes, who do you want to manage your money in an environment where there's a lot more macro volatility, a lot more uncertainty, right? You can't just buy assets and hope that they go up the way you were able to do over the last 15 years. It's really a time where alpha generation and the best alpha managers are really going to shine relative to passive index investing. And so that's what I think we're going to see over the course of the next 5 or 10 years, is we're going to see a totally different environment where alpha managers are going to really outperform. And the big issue, and I think that is in particular this year, because we're at this very difficult late cycle moment. Are we in a soft landing? Are we in a no landing? Are we in a higher for longer? Or the answer to all those questions, like, hedge fund managers have navigated the last year plus much better than index investors, right? Much, much better. And so to have them on your side ahead of what will certainly be a significant amount of macroeconomic volatility and asset market volatility, that's what you want to have. The big issue is the fees. That's the big issue, right? It's how do you get exposure to those managers, to that sophisticated asset management, but not pay 2 and 20. Because if you pay the 2 and 20, right, it erases all the value that those managers provide. I like to say often, hedge fund managers don't have a strategy problem. They have a fee problem. And so if you can address the fee problem and get access to that alpha at a much lower cost, you have a great opportunity to essentially hire those managers to help you navigate these uncertain times.
Yeah, got it. Because I wanted to ask that question, why now? Why launch this fund now? But I think you've pretty much answered that. I just want to kind of focus in on the performance of hedge funds last year. I think, based on the HFRI 500 fund weighted composite index, I think performance fell 4.25%. The worst year since 2018. So whether that's a fair reflection of the hedge fund industry as a whole, you can tell me. But, was last year a good reflection of hedge fund performance? And was, how did that inform your thinking about launching a hedge fund based strategy in 2022?
Well, yeah. So if you take that 4.2% and then you add back the fees, let's call it, close to neutral in aggregate at the hedge fund industry level, in aggregate, because the good performers charge management fees, and those that generated negative returns the good performers charge the performance fees, and those that were below zero still charge the management fees. And so on the order of a zero return last year, who wouldn't have wanted a zero return last year? Right? Yeah. Right? 60-40 investing, stock investing, bond investing down, 15, 20%, depends on exactly what your mix is and exactly how you want to do it. And I think that's a really important thing to highlight, because the way that you build wealth over time is by not going through massive swings in volatility. Yeah. Right? The way you build wealth through time is by generating pretty good returns most of the time and navigating and limiting downside risk in challenging times. And that's really, if you look at the history of hedge funds and how they have done well over time, how do they deliver that more consistent return stream that is equivalent to or better than stocks? Well, the way that they did it was by generating pretty good returns most of the time, and having a return stream that had less significant losses during challenging periods. And so, as I say, would you have taken, zero or a bit better than zero last year? I think most people would have done that. That would have been like a 95th percentile outcome for most fully invested investors, right? A zero out, a zero return outcome. And the important thing is that was zero. But then what happens is, if the question is, do you get exposure to the upside environments? And so, as an example, if you look at how hedge funds returned in January, it wasn't as good as stocks, but it was still up. I think our blended number is, let's call it 3, give or take, right? Okay, well, so that's pretty good. Like standing in 2021, at the end of 2021 relative to where you stand today, that's a pretty good outcome for most investors, and that's what you should, that's the sort of thing you should expect from a diversified alpha strategy over time.